Hi everyone, good afternoon. My name is Daniel Lee. I'm in the Office of Investor Education Advocacy here at the SEC. I'm going to tell you a little bit this afternoon about securities-based crowdfunding. First, an SEC disclaimer. The Securities and Exchange Commission, as a matter of policy, disclaims responsibility for any private publication or statement by any of its employees. The views expressed in this presentation do not necessarily reflect the views of the SEC, its commissioners, or other members of the SEC staff. Okay, next, crowdfunding. The picture gives you an idea. In November 2015, the SEC adopted final rules that provides for a new offering exemption, meaning a new way for retail investors to invest, or for those who are more entrepreneurial-minded to raise money. Securities-based crowdfunding. What is securities-based crowdfunding? If you're familiar with sites called like Kickstarter, GoFundMe, or Indiegogo, those are crowdfunding sites. It's a similar concept. We're raising money through relatively small contributions from a large number of people. But unlike those sites, for example, on Kickstarter, where you might be offering money for a token or for some product that they're developing, or on GoFundMe, where you're offering a donation, with securities-based crowdfunding, you're offering to invest in a security being offered by the company that you're looking to invest in. Companies can raise up to $1 million in any 12-month period. So with securities-based crowdfunding, you're buying a security that the company is offering. What we usually think of securities as common stock, which represents an equity or ownership stake in the company, but we'll talk later about other possible securities that may be on offer in these crowdfunding offerings. First, I wanted to mention the SEC's three-part mission, which is one, to protect investors, maintain fair, orderly, and efficient markets, and to facilitate capital formation. How does crowdfunding play into this? Crowdfunding provides companies the ability to raise capital by going to the public for individually small investments. The rules we passed in November 2015 were based off of a law passed by Congress called the Jobs Act of 2012. And the whole idea of the Jobs Act was to liberalize a little bit of our rules to allow for companies and to raise more money through various means, including this new exemption under crowdfunding. There's greater risk in connection with crowdfunding offerings, and how the risk is mitigated to investors is the fact that how much you could actually invest in any 12-month period is limited under our rules. And I'll get into those rules shortly. With crowdfunding, you have to go through an intermediary. If you're looking to raise money or you're looking to invest, it has to go through an online-based intermediary, either a registered funding portal or a broker-dealer. Intermediaries serve a dual purpose. They help the company, the issuer, they guide them through the crowdfunding offering process, help them follow the steps that they need to make the offering. And then they also provide educational materials that are very important for investors to read up on, letting investors know about the investment risks, confirming the limits that the investor is subject to, and providing a platform for the offering. Also under our rules, the intermediaries provide a communications channel where investors are able to log questions to the issuer, officers of the issuers, and vice versa in terms of understanding and what you're planning to invest into, getting more information, getting more knowledge about what you're planning to put your money into. FINRA, intermediaries register with us and have to be a member of FINRA. FINRA stands for the Financial Industry Regulatory Authority, which is a self-regulatory body made up of members of broker-dealers and now funding portals. This is a screenshot of their website that lists the funding portals they regulate. Let me try clicking on this. It should send us to a link on their website of all the crowdfunding portals that they currently have registered. You can find this if you go to finra.org and about FINRA and funding portals we regulate, if you care to find out where these intermediaries funding portals are. I'll get back to my PowerPoint. One thing to note, there's a disclosure requirement by the companies that are looking to raise money via crowdfunding. Initial disclosures will include like a description of the business and plan, offering details in terms of what security you're buying, the valuation on that security, and your rights vis-a-vis that security and vis-a-vis the company. Capital structure of the company, who currently owns the shares of the company, whether there's any debt outstanding, use of proceeds, which is basically what the company is planning to do with the money it raises, and financial statements, giving you a snapshot of how the company is at that point. That's initial disclosure when they're making the crowdfunding offering. Subsequently, there's an annual disclosure requirement, an annual financial statement disclosure requirement. With the financial statements, under our rules, there's a tiered financial statement requirement based on the amount of money you're raising. If the company is planning to raise $100,000 or less, it's basically just the financial statements certified by the principal executive officers of the company and certain line items from their tax return. If you're looking to raise $100,000 to $500,000, then the financial statements have to be reviewed by an independent public accountant with a report by that independent accountant. And if you're looking to raise $500,000 to $1 million, then those financial statements, if it's the first time you're crowdfunding, also has to be reviewed by an independent public accountant. But if this is not your first time crowdfunding, then the rules require those financial statements to actually be audited by an independent public accountant. The difference between an audit and a review is an audit is much more intense. There's a higher level of scrutiny by the independent accountant than a review is. Just to give you some highlights of the offering mechanics, what you expect to see in the crowdfunding offering process, disclosures have to be available for at least 21 days prior to the first sale under the offering, first sale of securities under the offering. Investors have up until 48 hours prior to the closing of the offering to cancel any investment intent that they've indicated. Once a certain price is reached, the offering target is reached, the issuer or the company can close the offering at any time. And if there's any material change to the terms or to the disclosure that's provided about the offering, the investor has to affirmatively recommit, or their investment intent is automatically canceled. So that's a level of protection for the investor in the sense that if the company makes any changes to the disclosure, the investor has to know about that change and has to affirmatively recommit to their investment intent. Now we get to investment limits in terms of how much as an investor you can invest. It's a little complicated definition, but after you work with it a little bit, it becomes a little more manageable. But if either your annual income or your net worth is less than $100,000, during any 12-month period, you can invest up to the greater of either $2,000 or 5% of the lesser of your annual income or net worth. If both your annual income and your net worth are equal to or more than $100,000, then during any 12-month period, you can invest up to 10% of annual income or net worth, whichever is lesser, but not to exceed $100,000. So in the next slide, I'll go through some quick examples. Actually, let me get to this. Notwithstanding the investment limit requirements, another wrinkle with how much you can invest is that when you're calculating your net worth, unlike your normal common sense definition of net worth, our rules require you to exclude your primary residence as well as any mortgage or other home loan connected to that primary residence from your net worth calculation. And in terms of excluding the mortgage, you can only exclude the portion that's within the fair market value of your house. Any part of your home loan that's above the fair market value of your house or that's underwater, you have to also count as a liability in your net worth. You also have to include, if, for example, on a home equity line of credit, you took out a $10,000 amount from your home equity line of credit 30 days ago, you have to also count that against your net worth. That's just a way to prevent any kind of engineering with regards to your home equity line. So just a couple of straightforward examples. The first row could be one of your students, or somebody in college. No income, no job, no net worth. They can invest. That person can invest a maximum of $2,000. The second line item, let's say somebody who just graduated from college and who got their first job but has some student loans. So they have annual income of $30,000 and they owe about $80,000 in terms of student loans. They again can invest up to a maximum of $2,000. Next two examples, let's say somebody who's been out in the workforce for a few years. They have a net worth of $25,000 and annual income of $45,000. Based on the calculations, they can invest a maximum of $2,000 because it's a greater of $2,000 or 5% of the lesser of either your annual income or your net worth, and that would result in $1,250. So it's the greater of $2,000 or $1,250. So your maximum is the $2,000. With the next example, the last example, let's say one thing I forgot to mention is with your investment limit calculation, you could either include it individually or you can include it jointly with a spouse. And so let's say, for example, between you and your spouse, your annual income is $110,000 and you have a net worth of $200,000. This can include savings, retirement accounts, but not including the value of your home and any mortgage connected there too. It becomes 10% of lesser of your annual income or your net worth, lesser being the $110,000 annual income, and so your investment limit is $11,000. See, next slide. One thing to keep in mind is with regards to the securities that you're purchasing from these crowdfunding offerings, there are resale restrictions. Investors are restricted from reselling shares for the first year unless the shares are transferred to the company that's the company is buying back its securities from you, to an accredited investor, which is a securities law definition. Usually, from an individual standpoint, it's somebody with high income of $200,000 individually or $300,000 together, or you have $1 million in net worth. To a family member, in connection with a death, divorce, or similar circumstance, or to a trust controlled by the investor, or a trust created for the benefit of a family member, or an offering registered with the SEC. An offering registered with the SEC usually means, for example, like an IPO. An IPO is your most commonly understood offering that's a definition for an offering that's registered with the SEC. This is probably the most important slide of this presentation, is the risks that are connected with investing in a crowdfunding offering. I want to point out the most important risk, these are what I think are the 5 most important risks. First risk is illiquidity and the resale restriction that we just talked about. One, with the resale restrictions, you can't sell within the first year. Illiquidity relates to the fact that this isn't the same as investing in, for example, a company listed on the NYSE or NASDAQ, and you could, even after the 1-year resale restriction, you could go on the stock exchange and sell your securities the next day if you change your mind. Illiquidity means that you might have a hard time finding a buyer for your securities after that 1-year resale restriction is up. You may have to locate an interested buyer, and that may or may not happen. So you might be holding on to securities that you might have to hold on to indefinitely. There's speculative risks. You're investing in companies that are basically startup in nature, from the ground up. So you're investing in companies that have a high risk of failure. That was a big concern with regards to these crowdfunding rules, was subjecting retail, offering the opportunity for retail investors to invest in these high risk offerings. But it's mitigated by the fact that depending on how much you invest, you can invest from as little as $50 to $2,000 or whatever the investment limits are calculated for you. So in terms of how much you invest, that's what you're risking in terms of what you're putting your money at risk of. There's the cancellation restrictions. I mentioned a little bit earlier about the offering mechanics and the fact that you have up until 48 hours prior to the closing of the offering to cancel. So you have a right to cancel if you change your mind during the offering process, but keep in mind, if you're within 48 hours of when that offering is planned to cancel, you can't cancel during that period. For example, if an offering is coming up really close to its cancellation deadline, to its offering deadline, I mean, and it's suddenly getting all this interest, and you decide to jump on at the 11th hour because of all this interest, you can't back out at that point if it's within 48 hours of the offering period. There's limited disclosure. There's requirements to provide that initial disclosure, and there's requirements for annual disclosure thereafter. But even then, the disclosure is limited compared to the amount of information that publicly listed companies have to provide. And you're not going to get the kind of quarterly reports and the full breadth of information that you get from quarterly reports and annual reports that publicly listed companies provide. So it's not the same as investing, again, in publicly listed companies. The amount of information is drastically different from the level that publicly listed companies have to provide. This crowdfunding is relatively new, there is a possibility of fraud with regards to crowdfunding offerings. Just hypothetically, there might be an offering that's offered, and the person might be singing a great story about how well about their business plan and what they're thinking to do with your money. And notwithstanding the fact that intermediaries, funding portals, are charged with trying to make sure that there isn't any kind of fraudulent offering, there's no guarantee that one might not slip through, and you might not be subject to putting your money into a fraudulent offering. Now, securities. In terms of crowdfunding offering, the securities isn't limited to common stock. Common stock being the stock that you often think of when you invest in, for example, again, a listed company like Ford or Microsoft or GE. Common stock represents an equity stake in that company, an ownership stake in that company. That certificate means you own a piece of that company. Other securities that we've seen that have been offered in crowdfunding offerings are convertible notes, which is debt. So it's basically a piece of paper, a note that says you're lending money to this company in exchange for a piece of paper indicating that that the company has this loan and owe you this amount of money, and pursuant to the terms have to repay it at some point. But a key feature of these is that it's convertible. Is that depending on the terms of the convertible notes, it will convert at some point into equity of the company. And the trigger could be a subsequent financing round, or time 5 years hence, or some other trigger. And so it's very important when you're looking at this to understand the terms, if it's not common stock, or whatever security that is being offered. Another security we've seen that's being offered is what's called SAFEs, which stands for Simple Agreements for Future Equity. This is an agreement basically for future equity, as the acronym stands for. But the interesting thing is, unlike convertible notes, which is a piece of paper saying the company owes you this amount of money, and at the end of the day has to own up to it, whether it's through an issuance of securities because it converts or they pay you back at some point. Otherwise, it's a legal obligation you hold against the company. A SAFE isn't a debt instrument. It's an agreement that the company will provide you future equity based on the amount you invest, based on a trigger. The trigger again being either a subsequent financing round, sale or merger with another company, or an IPO, for example. But what's important to remember is that sometimes there may be a scenario where these triggers do not work out, and that safe may or may not get triggered. And you would, at the end of the day, unlike a convertible note where the company owes you money, you'll just have a piece of paper that never gets triggered. What's important to also keep in mind is the safes were created in Silicon Valley as a means for a lot of for venture capital firms to invest quickly in the hot startup of the day, and this was a way to get in without too much negotiating. And the VC, the venture capital firm, was more than willing to lose a little bit of money being able to get in on the ground floor of what could be the next Uber or Facebook. You likely may or may not have that opportunity with crowdfunding offerings. Being able to invest in the next Facebook or the next Uber. The odds of that happening are very slim. And from my quick survey of crowdfunding offerings, they run the gamut of your local coffee shop or some restaurant idea in the area to some consumer product-oriented company to some other larger idea. It's just you just be careful in terms of keeping your eyes open when if you're interested in this crowd-funded offering space, and knowing that it's not the company that you're looking at may likely not be the next Facebook. Next, I just want to mention our Investor.gov website, which is a great resource to learn about securities investing. And we also have a great bulletin. Let me see with clicking on it. If you type in crowdfunding, we have a great investor bulletin where you can learn more about crowdfunding. And here we go. And that's it.
Thanks, Daniel. I appreciate it. A couple of questions for you. One, just to clarify, I think you mentioned Kickstarter in the beginning. So the difference between crowdfunding and equity crowdfunding is that, and I just want to make sure that we clarified for everybody. In equity crowdfunding, you're going through some portal that's been vetted and approved by FINRA. Whereas in just regular crowdfunding, you are, and with equity crowdfunding, you're getting some type of form of ownership, debt from the company. In standard crowdfunding, you're getting, in exchange for your money, you're getting, a T-shirt or some product. Is that an accurate sort of oversimplification of this?
Yeah, no, that's right. The idea with crowdfunding, with Kickstarter and those sites, is that you put in your money, excuse me, and you get either a token or a T-shirt or something based on the amount you contribute. With equity crowdfunding, you're getting a security being issued by the company. The intermediary is not necessarily vetted. They've registered with us with the FINRA, and they basically followed the rules in terms of becoming a funding portal. And then they're charged with, at that point, in terms of helping companies, issuers, list their offering on their website. And so FINRA registers, gets membership from the funding portal, and then the funding portal is then charged with helping the company get on their website and get their offering off the ground, and then become a meeting place for investors to explore the offerings and to invest. And when you're investing in equity crowdfunding, you're getting a security. You're getting either common stock, which represents an ownership stake in the company, or some other security that indicates your investment in that company, whether it be a convertible note or common stock or be safe. Does that help?
Yeah, that does. Question from the audience: is there a profile of a typical investor for crowdfunding? And if so, can you kind of give an idea of what that typical investor is, or who that is?
I don't know whether we have information necessarily on what the typical investor profile is. Division of Economic Risk Analysis actually just finished a study about crowdfunding. It's on the SEC.gov website. And one interesting nugget from their research was that the average investment in a crowdfunding offering is about $800. So and that's just from what I understand, just a quick amount of money raised divided by how many investors there are. So right now that number is $800, which is a good amount of money, but right now it's less than the $2,000 max, or that at least a $2,000 minimum threshold for the investment limit. So that's about as general investor profile at least I know of, which is the average amount being invested. But I imagine it's probably somebody who's not necessarily an active investor, but a knowledgeable investor who has investments in the stock market. So they know about securities, they know about investing in stock, and they're looking to possibly throw in a little bit of money into companies with more of a startup nature, whether it's because they want to actually maybe have some stake in the hot new restaurant that's coming up in their neighborhood or their city, and that concept is putting out a crowdfunding offering to fund that enterprise, or they see some business that they feel could be something worthwhile to put their money in, and so they're just putting some money into that.
So one way to teach this, or for our teachers to think about this, is this is a new form of investing. We traditionally taught kids the difference between, say, stocks, bonds, and mutual funds, and those vary in their risk in comparison to maybe some saving vehicles like a savings account or a certificate of deposit. This adds something new to this world, which is to invest in businesses. This is sort of before you become a venture capitalist and are the next person in one of the fancy seats on Shark Tank, right? Yeah. But the other flip side would be if you're teaching students about entrepreneurship and about ways to fund a business, that this is also one of the routes to consider, as an entrepreneur, looking at ways to try and sort of get money. So, and it would definitely have its pros and cons from that point of view as well, don't you think?
Yeah, I think for any entrepreneurial-minded students, this could be an avenue to explore in terms of starting their enterprise. It doesn't. I've seen crowdfunding offerings for local coffee shops and stuff. So it's not just if you have a business that can grow, a business idea that necessarily can grow exponentially. It can also be something a little more local in nature. The idea is to maybe find your audience in terms of investors that are interested in being a part of your story. In terms of investment, it's technically, if you're getting common stock, it's technically a stock. But then one thing, if you're letting your students know about crowdfunding, I would definitely want to impress is that it's not necessarily the same. It doesn't have the same profile as, for example, investing in bonds and stock, in the sense that there's some level of I guess safety and expectations you have when you invest in, let's say, a blue chip stock or a government bond or even a corporate bond. When you invest in crowdfunding, it's very speculative in nature, and there may or may not be an opportunity down the road to get your money back. There's the risk of failure by the company, and there's the illiquid nature of the security that you're purchasing.
So I think there's time for one final question, and that is there a great deal of fraud with this type of investing, and what are your concerns sort of on the fraud side here?
Well, let's see. I could point to one thing. The SEC did take action against one funding portal that it looked like was manufacturing a number of these offerings. A lot of the offerings have the same similar language. And that's why I think FINRA put out their list of former funding portal members, and that funding portal was kicked out. So they're within the first the rule went live, I guess, in May. So within the first year, there was an action taken against the funding portal and the related offerings. So that's just one solid example we have so far.
And can companies be listed on more than one funding portal? So like if I went to 5 or 6 of those to see what they were offering, if I see a company listed on more than one, should that give me concern, or is that okay for them to do?
You have to go through one funding portal.
Okay.
It cannot. If you see them listed on multiple funding portals, then the funding portals aren't doing a good job.
All right. Well, very good. Thank you so much, Daniel. Really appreciate this. I think this is something that is definitely new. Somebody said to me the other day, well, financial education, it's you teach the same thing all the time. How much changes? I'm like, well, things do change. As a matter of fact, we have new things that people can invest in, and things do change in the financial services industry quite a bit. So this is one such example, and I appreciate you spending your time to let our teachers know about it and keep them informed. So thank you so much.
Sure. This was actually quite a seismic change from the standpoint of us as a securities regulator in terms of having rules to open up these kind of offerings to individual investors. But yep.
Perhaps a sign of things to come. Who knows? I guess only time will tell. So, well, thank you. We really, really appreciate it.
Sure thing.